I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mates, the podcast where we break down the world of investing to make it easy and accessible for you. Welcome to episode 17, and for the first time in a long time, I'm here with my equity buddy in real person. We're not recording over Skype like we usually would. I'm down in Melbourne. How are you, Ren?
I'm really good, Bryce. Good to be with you.
Yes, it is great.
Great to be seeing you in person.
I know. It's been a long time.
It has.
So this episode is all about investing styles and what works for you. And there's 5 investing styles that we're going to be going through today. Some that we have discussed in previous episodes, others that we may have briefly touched on. But we thought we'd take this opportunity to really go through some of the key characteristics of these investing styles to sort of find what may work for you and what style's good for you.
I know when I started investing, I would have really liked to know the different ways people invest, because you can get lost in all the charts and the different numbers and the different things that different people talk about. And it's good to just know what the different styles are, what you should look for, you know, what styles you understand. So,
and it's a good basis as well, you know, when you're reading articles, doing research to get an understanding of what these guys are talking about, because if someone's talking about quantitative investing, you might have no idea. So this is going to be the podcast that lays it all out for you. And as always, we're going to start with what have you learnt this week?
Yeah.
So do you want to kick this one off, Ren?
Yeah, sure. Well, look, after your Netflix recommendation last week...
Which was an absolute hit.
Yeah.
Did you watch it?
I haven't yet. But I thought I should bring a Netflix recommendation to the table to start with.
Movie review podcast?
Yeah. Nah, look, this isn't my what I learnt, but just I did see something on Netflix that I thought people would appreciate.
Okay.
It's called Silicon Cowboys.
Okay.
And it's about Compaq, the computer company, and how they took on IBM, who was, you know, the only player in computing at that time, or the biggest player in computing at that time. So for anyone interested in the early days of Silicon Valley, good one to check out.
Interesting.
Yeah.
And what was the result of the documentary, or will it give too much away?
Well, they are still a company, so
Okay.
yeah.
Okay.
No.
So what's been your major learning then outside of Netflix?
Yeah, okay. So I have just finished a book called Buffettology.
Okay.
Now, it was written by Mary Buffett, who is Warren's daughter-in-law, married one of Warren's sons.
Okay.
And it's a great book. Highly recommend it. Check out the upcoming book review that we'll be putting on Facebook and on our website. But there was something I took out of it that I thought is a really useful learning.
Mm-hmm.
Now, the book was written in 1996, so we're looking at about 20 years ago now. And at the end of the book, Mary lists 54 companies that Warren has invested in.
Okay.
And that gives us a great insight into some of the things he looks for. But my biggest takeaway from that is that you don't have to bat 100 as an investor. No one nails every one of their stock picks, and you can become the richest man in the world like Warren Buffett without nailing all of your stock picks. So I thought I would run through some of them just to give you an idea of how poorly some of them have gone.
Okay.
But also we'll celebrate some of his successes as well.
Good idea.
So, you know, there was some absolute cracking investments in there. Now, there's a term that I'm going to use here. It's split adjusted. And what that means is if I buy a stock for $2 and then they split it, so as a shareholder, if I own one stock and they do a 2-for-1 split, then I have 2 stocks. If I paid $2 for that one stock and then they split it, my split adjusted price is $1.
Yeah. But your total value is still the same.
Its total value is still the same, but because they doubled the amount of shares that I own, you halve the split adjusted price that you paid.
Yeah.
The reason that I want to introduce that term is that a lot of the stocks that Warren bought have split, so we'll talk about what he paid in split adjusted terms.
Okay.
So let's go through some of his big winners, just to give you an idea of some of the ones he hit on.
Quick question before, is this 54 Did she give a reason why these 54, or are they all 54 at the time of writing that he was invested in? Were there any others that he was invested in she hadn't mentioned?
Oh, probably, yeah.
Okay,
yeah.
Okay. So this is just a list of notable ones.
Yeah. And it was to illustrate some of the ideas that she's talking about in the books. In the book, some of the things that he looks for when he's picking stocks. And yeah, just, to give people something to start their research, I guess.
Okay.
But yeah, some of his big winners. So Coca-Cola, he paid $4.64 a share in split adjusted terms. They're now in 2017 worth $45. So he's done pretty well with that. He's made 10 times his money. Walt Disney, he paid $6.48 in split adjusted terms, now $102.
Wow.
Yeah, McDonald's, $11.25, now $159. Tiffany, the jewelry maker, 78 cents a share, now $88. Walmart, $5.57, now $78. So, I mean, like when you pick a winner and you hold a winner, you can do very well for yourself. And these are the companies that Warren's sort of known for, and he's obviously where he's made most of his money. But, there's always a but coming. He also has had some shockers.
Okay.
And we all have shockers. I very publicly on this podcast talked about one of my early shockers with Slater and Gordon. But some of Warren's shockers, there was a company called Circuit City that was a big technology retailer. I guess in Australia, your equivalent would be like Harvey Norman or something. He bought them for about $30 a share in 1996. Well, that's what they were trading for in 1996. By 2009, they were 4 cents a share, and then they declared bankruptcy. Lost everything.
Wow.
Another one, Bear Stearns. Now, some of you guys might have heard about this from the financial crisis. When they float, I had trouble finding their 1996 share price, but they floated in the 80s at around $25 a share. Pre-GFC, they got up to $180 a share. But then after the GFC, they got bought out for $10 a share.
Wow.
Yeah, so he would have lost money on that. You can look at some companies that still exist, and he wouldn't have done that well on. So he bought, there's a company in America, the Federal Home Loan Mortgage Corporation. It doesn't really matter what they do. In 1996, that split adjusted, they were trading at about $5.13 a share. They're now $2.47 a share. So the value is more than halved. Another one, New York Times. Everyone's heard of them.
Interesting.
They used to be a huge
Gold
company.
mine.
Yeah, rivers of gold because of the advertising. In the mid-90s, they were trading around $14, $15 a share, split adjusted. Now they're only $18. So, in 20 years, they've increased a couple of dollars.
Not a lot.
Yeah, so it was just an interesting takeaway that you hear about his success, but even the greatest investor of all time, he doesn't nail every pick. It is impossible to do so, and it's silly to think that anyone can.
Yeah, good lesson.
Yeah, so take your beatings and just keep trying, and who knows?
I wonder if those companies that he's had winners on, or even all of those companies, I know he obviously still holds a lot of them because that's his strategy. But would he necessarily buy them from scratch again?
Yeah, that's a good question. Yeah,
because those companies back in the day certainly probably don't have the growth prospects today that they would have 20 years ago.
I mean, especially a company like Coca-Cola.
Yeah,
you think people's aversion to sugar and stuff like that, more competition in the drink space. Yeah, they're much more expensive than they would have been back in the day. But who knows? Like the thing is, in the mid-90s, these companies were household names. Like Coca-Cola, McDonald's, Walt Disney, Tiffany, Walmart, all five of them. Like, they were big brands.
Yeah.
So it's not like he's, picking obscure stocks that no one's ever heard of. He's just recognizing that what they're trading for then is good value.
Yeah. He's always been one for brand power as well. Power of the brand. Yeah, nice.
Yeah, okay. So, what did you learn?
Well, I promised that I would step up my game from last week, which was purely a Netflix documentary, which I still recommend you watch.
Yeah, I will. I'll get to it, yeah.
So, there's been a lot of chat, and we've spoken a lot about Amazon, the big online retailer. But what we haven't really spoken about is the other hidden giant in Alibaba.
Okay.
And for those that aren't aware of what Alibaba is...
It's that kebab shop, isn't it?
Yeah, it's the kebab shop in the corner, just down from my street.
Yeah.
So yes, there is an Alibaba kebab shop. The one I'm talking about is the Chinese online retailer.
Yeah.
A huge company, the equivalent of Amazon, but for the Asian market.
Yeah.
And in fact, it's bigger than Amazon. Two things that I've learned and that I want to highlight. They have just done, and in line with our reporting season episode last week, they released a number of figures that for their last financial year that I thought I would point out just to give everyone an indication of just how big these guys are, to sort of paint the picture a bit. And so let's just start with annual active buyers on the Chinese retail marketplace reached 454 million people.
Okay. Yeah.
So that's more than the population of the United States.
Yeah, but still is only, what, a third of China's population?
Yeah. So their growth potential is enormous.
Do you know if that's all in China?
So it says in their financial report. So it says annual active buyers on our China retail marketplaces was 454 million.
So in China.
Yeah.
That's unreal.
So that just gives you an idea of the scale in which these guys are operating. Now, to give you an idea of their revenue, they had an increase of 56% to 22 billion. Revenue from cloud computing increased 121% up to almost $1 billion. They're in digital media, they're in innovation initiatives, and the increase in the Chinese marketplace was 31 million. So I just want to highlight that this goes into my next point, which is they are now going into retail stores, bricks and mortar. So like Amazon, they're recognizing that they need a footprint on the ground.
Yeah.
And what they're doing is like Amazon, is merging retail bricks and mortar with technology. And so what they've done over the last 12 months they've blended their online marketplace so that customers can order, buy, and also get delivered products from these bricks and mortar shop fronts. So they can go in with their app and do all of it on their phone and walk out with products.
Okay.
So that cuts down on the labour costs.
Right. Oh, so you don't go through a checkout. You pick something up off a shelf and buy it on your phone.
That's right. That's right.
Okay.
And they're integrating food, clothing, electronics all into this model. And exciting thing for Australia is that their demand for produce, specifically fresh, and also a lot of our top quality nuts, wine, baby formula, is now being driven by this model.
Okay.
And so they're trying to stock these supermarkets that they're developing with Australian produce and products.
Great.
So I just wanted to say that, both of us work in retail, and so it's interesting to see that their growth is massive, their market's huge, and, everyone's talking about Amazon and the effect that it's going to have on the Australian retail market, but you've just got this hidden giant in Asia slowly ticking away, and who knows, one day they might be coming to Australia just like Amazon are. But yeah, it's interesting they're combining technology with bricks and mortar stores in a way that is they're trying to make it seamless.
It's funny that they both, Amazon and Alibaba, start as online e-commerce retailers, and then they both go into cloud computing, and now they're both moving into bricks and mortar retailing, charting very similar paths. Yeah.
And I just think it's really hard to go the other way.
And go into e-commerce.
Right. For the Australian retailers who aren't known for their e-commerce, I think it's going to be very hard to get that brand image in consumers' minds. That's an option as well.
Oh, I mean, brand image, and then also just the logistics of it all, and it's a completely different ball game to filling a big store or a big supermarket or anything like that.
A real battle, especially in it's going to be interesting to see what happens.
Yeah.
We keep harping on about
It'll be interesting to see if they are ever directly competing in a new market together. Amazon's currently competing in India, but maybe they both go to Vietnam at the same time or something, and it'll be interesting to see how these two giants who do very similar things, who wins. Yeah.
My bet's on Alibaba, I reckon.
In Asia, my bet would be on Alibaba.
Yeah.
It would be very interesting to see in an Australian context, because Amazon, obviously they've got a little bit of a footprint here. They're already starting to roll some things out. They've got experience going into new markets. But Alibaba is from China, Australia's biggest trading partner. There's probably some efficiencies they can get there.
They just don't have the media attention that Amazon does.
No, that is true. Yeah,
so Amazon's already a known name.
Yeah. If you want to see something crazy, just talking about Alibaba, Google China's Singles Day.
Okay.
It's the biggest e-commerce, or it's the biggest trading day in anywhere in the world, and it is just like a 24-hour buy-a-thon. And Alibaba have they get Western celebrities in to do concerts that are televised, and they are advertising their products through this day, and they sell, I think at this stage it's like billions of dollars worth of product in one day.
Wow.
Yeah, China Singles Day. Everyone should Google it. It's crazy. Yeah.
Wow. All right, so now to the main segment. As we said, we're going to break down five investing styles and go through them. We're going to talk about some of the characteristics. I'm going to play a bit of a game with Ren at the start, test his knowledge.
Yeah.
He threw me, well, not threw me under the bus, but gave me a few tests last week.
No, and you passed with flying colours.
We'll give you some tools that you can use. We'll talk about some of the books you can read for these styles, and we'll also make mention of any notable investors that are out there utilising this style to their advantage. So
I reckon the best thing to do is to listen to the different characteristics and think about what resonates with you and what makes the most sense to you.
Yeah.
Because I know for me personally, there's one that just intuitively makes sense to me, and the others not as much. And so I naturally resonate towards that.
And we'll do a wrap up with that at the end. So here we go. I'm going to do a Who Am I to Ren. And the Who Am I are going to be based around the characteristics of these investing styles. Now, some of them may be a bit left field, but we'll start with one of them and see how we go. So, one of my goals is to determine the intrinsic value of a company and to compare it to the market price. My analysts determine the health and performance of a company by looking at key numbers and economic indicators. If you're an investor evaluating financials, company management, macroeconomic, industry conditions, then you're investing in my style. And using financials such as return on equity, earnings, future growth, cash flow, Warren Buffett invests in my style to find underlying value of a company.
Okay.
Who am I?
Who are you? That would be a fundamental investor.
Yes.
Okay.
So, the first investing style we're going to discuss is known as fundamental. And as I mentioned in there, it has a few characteristics that we've generally spoken about a fair number of times during this podcast. So, Ren, do you want to give a couple of characteristics about investing in a fundamental way?
In a nutshell, think about stocks as the companies that they represent, and you look at how the company's going. You look at its financial statements and see how much money it's making. You look at its competitors and demand and stuff like that, and see how much money it could make. And then you invest in it if you think it's a good value buy, or it's going to grow a lot. You don't worry too much about the day-to-day fluctuations. Yeah. You think about you think in a longer term manner. Yeah. About the stock as the business.
Yeah. This is where you're buying the actual business. I mean, you are in all investing, but this is that mentality. Yeah. You look at everything from management through to, as you mentioned, the financials, profit and loss statements, and you try and come up with your own underlying value.
So I guess under fundamental, fundamental as like a broad label, you're looking at companies and how they're going to go and how they're performing. Under that, there's probably three different ways that you can go about it. Mm-hmm. So doing your fundamental analysis and looking at the companies, you can try and look for value, which is the first one. Yeah. And that's when you're looking for companies whose share price is lower than the intrinsic value,
Yeah.
which is just a term that loosely means what the company is actually valued at based on how much money they're making and how much money they can make in the future.
Yeah.
The second one is you do your fundamental analysis to try and find growth opportunities.
Mm-hmm.
And so that you're not so much worried about the price you're paying now, but you're projecting forward based on their opportunities and how the company's set up and their management, that they're going to grow a lot in the future. And that even if they're relatively expensive now, because of the growth opportunities, you'll still make money on them in the future.
Mm.
And then the third type is, which we might get some noise about, but I think it comes under fundamental, is you could be looking for income.
Yeah.
And so that you're still doing fundamental analysis. You're still looking at a company. Sometimes you can be looking at other asset classes like bonds, but let's not get into that too much. But essentially you're looking at whatever the investment opportunity is and looking at how much money it will make and how much of that it pays back to its investors in income.
Yeah.
And you're trying to find good income streams from it.
Yeah, I agree.
Yeah. So although those three types of investing lead to very different companies, but they all require the same fundamental analysis to make those decisions.
Yeah, definitely. No, I agree with that. And, of all the five, I couldn't really put them under anything else other than fundamental.
Yeah. Now, do we know any fundamental investors? Do we have any equity mates that?
Well, the very first interviewee that we had on the show, Andrew Brown, episodes 5 and 6, I think it was.
Yeah.
He is a fundamental investor.
Yeah. He truly puts the fun in fundamental.
Yeah, Andrew Brown. So he actually sits down and nuts out. We were in his office, and it's pretty crazy some of the stuff that he's doing. But wholeheartedly looking for true value in his investments. Yeah. And he is sitting there day in and day out trying to find stocks that he think are undervalued to what they're currently paying on the stock market. Yeah. So if you really want to go back and have a listen to him, he was a fantastic interview and really nuts out what it means to be a value investor and what are some of the things he does to look for value in a company. Yeah.
And to illustrate that example of growth, value, or income, so Andrew was talking about companies like Channel 9 and Fairfax Media, who he did his fundamental analysis, looked at their balance sheet, looked at their annual reports, and thought that the price on the share market was lower than their actual value. And so they're the companies that he's attracted to. Mm. But if you're a growth investor, you would look at those companies and be like, well, there's not a lot of opportunities for growth. Mm. And you would be led towards companies, these days it's more like Seek.com, real estate, car sales, those kind of companies. But then you could do your fundamental analysis, and if you were interested in income, you wouldn't be interested in any of those two sets of companies. You'd be thinking more along the lines of some of the big miners like BHP and Rio or Telstra, companies like that. So you do the same analysis, you look at the same information, but depending on what you're interested in and where you think, the investment strategy, what investment strategy you think makes the most sense, you're going to be attracted to very different companies.
Yeah. In terms of tools that are used in this in this style, I guess all three of them would be looking at the basic financial statements of the business. Yeah. So that would be a good place to start. Now, obviously, for beginner investors, if someone was to say, let's find the value of this company, like, where do you start? It's a very skilled thing to be able to do, and everyone has their own idea of what's important in a financial statement and what's not. But it's worth highlighting that the general tools used to begin with in this style are financial statements, profit and loss. You look at the things like debt, cash flow, that sort of stuff. Yeah. As well as we mentioned before, you can look at their annual reports to get an idea of management and a general sense of the industry as well. Yeah,
definitely. Nice one. Any books or anything that people can follow up if they're interested?
Yeah, well, I think both of us have read The Intelligent Investor. Which I think is definitely a great place to start. Yeah. Very well known.
It's sometimes a bit of a slog to get through.
Yeah. Very old book.
Yeah, it was written by Benjamin Graham, who was Warren Buffett's mentor and was really the father of value investing. And then the book that I spoke about earlier in the episode, Buffettology, by Mary Buffett. I reckon that's the best book I've read on Warren.
Wow.
Just some of the detail, and it gets very specific, which is nice. So I would highly recommend that one as well.
All right, well, I'm going to get into that. And one that is a very easy read, very, very easy read, and really lays out in a very clear and easy to understand fashion what is value investing as well. It's based on value investing and really gives some tools that you can use right off the bat to try and start finding the values of companies. There's a book called Shopping for Shares, which is one that I'll review in a few episodes coming up. So I know Ren's got his ideas about the book.
Bryce has been telling us that he's going to do this this review for about 6 months now. It's coming.
Yeah,
it's going to be one cracking review.
Pressure's on. So, and we'll just quickly finish on the fundamentals with some famous investors of this style, and it goes without saying, Warren Buffett and as Ren also mentioned, Benjamin Graham, the two big dogs, the fathers of this. Yeah.
One other that I'll throw out there just to plug one of my old blog posts. Seth Klarman is another very famous value investor. Check out my review of his book, Margin of Safety.
Which was also recommended by Andrew Brown. So that's the first style, fundamental. As Ren has said, it covers value, income, and growth. That's our way of looking at it. And
it's just in a nutshell, it's all about looking at the company.
Yeah, it's about the company. All right, so let's move on to the next. Who am I?
Okay.
I pay extra close attention to the numbers and not the intangibles, and operate at incredibly high speeds. I use complex mathematical models to try and identify any investing opportunities. I don't care about the management or value of the company. Computers enabled my style of investing, and teams of mathematicians, programmers, and investors work to build proprietary models to try and beat the market. It's often said that my style of investing never loses money. Who am I?
Never loses money, you say?
Yeah, that's a big call.
Equity Mate's hypothetical portfolio.
Well, where are
no,
who am I?
This would be quantitative investing.
Correct.
Yeah.
Quantitative investing. Now, some of you may have heard of it, some of you may not have heard of it. I wouldn't be surprised if you hadn't, because on a historical scale, it's a reasonably new style of investing. Probably
started to make ground in the 80s, but really has shown its potential in the 90s and the 2000s.
Yeah. And what's the reason for that?
Mate, computers are fucking good at their jobs. So straight off the bat, I think it's important that we make it clear that computers are now used in all types of trading.
Yes.
You know, like fundamental analysts will use computers and they will use algorithms to try and identify trading opportunities.
Yeah.
When we're talking about quantitative trading here, we're talking about things that only computers can do.
Yeah.
So it's not, I've built an algorithm to try and find growth companies or value companies. That's not what we're talking about here. We're talking about things outside of that realm where the computers are executing trades that humans can't do.
Yeah.
Yeah.
And these quantitative traders, they're technology companies.
Oh, crazy technology companies.
Big dogs who have...
These are maths and science PhDs in a room building just the most outrageous algorithms and just... Oh, it is pretty phenomenal.
They didn't sit there and study Bachelor of Commerce or Finance.
No.
These are serious computer nerds who are making a lot of money. Yeah.
So I guess maybe the best way to explain it is by way of some examples.
Yeah.
So what some of the main ones, and one that you might have heard of is high frequency trading.
Yes.
And so that's essentially where the algorithms trade on the tiniest differences in price on different exchanges. And we're literally talking about them in milliseconds here. Yeah. So there's a fiber optic cable wire that runs from New York to Chicago in America.
Yeah.
And it was built to get the time it would take to execute a trade or for information to flow through from 17 milliseconds down to 12 milliseconds.
Which leads to millions and millions of
Oh,
dollars.
billions and billions of dollars. Think about building a fiber optic network from Chicago to New York. Think about how much trouble Australia's had building the NBN.
No, I mean the difference in that 0.5 of a millisecond is billions of dollars.
Yeah.
Opportunities.
It's so much. Yeah. So that's what we're talking about here. They literally trade so quickly and just on tiny little differences in the bid or the asking price for certain stocks, or the what it's listed on in the Chicago Commodities Exchange versus the New York Stock Exchange.
Yeah.
And they just trade in such high volumes so quickly that you make like a fraction of a cent here, fraction of a cent there, fraction of a cent.
Yeah.
Bang, 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 and end of the day.
And as you mentioned right at the start, these algorithms don't care at all what this company is. The company is called be named A, B, C, D, E, F, G. All they're looking at is taking advantage of the price movements of the stock on the market. They don't look at anything to do with the fundamentals of the company at all. They're just algorithms that are trying to capitalize on your everyday, on investors buying and selling, and them trying to make a buck out of it.
Yeah. Now the big question is this trading? Like, if these computers can just kill us as human traders, like, what's the deal? Like, what's the point of even trying?
I mean, I'd do it if I could.
If I was a maths PhD, I'd be working for them. But no, look, so they invest very differently to the way that humans invest, and so it would be silly to try and beat them at their own game. But at the same time, if you have a longer time horizon, and if you are looking for companies that will grow, and computers can do them, but they're not necessarily doing them better than humans. Because, for example, if you're trying to identify growth companies, the computer can look at things like financial statements and different ratios and pick things out. But at the end of the day, it comes down to human judgment about
trends,
market potential, trends, branding, all that stuff.
Yeah.
So stick to what humans can do better than computers, at least until AI comes along and flogs us on that as well.
Yeah. Well, this is not really investing in its purest form, really.
No.
It's as we said, just making use of incredibly powerful computers to take advantage of movements in price.
Yeah. And, there are arguments for this, like high frequency trading and some of the different other, statistical arbitrage and stuff that quants do. It gives markets liquidity and stuff like that. It closes the bid-ask spread. Yeah. These are all terms that a lot of listeners won't understand. Don't worry, I don't really either. And you don't need to. It is a different world, and it's a world that I'm fascinated by, but I'm not smart enough to be a part of.
We'll never be involved.
It's not. It doesn't mean you can't make a lot of money. Warren Buffett has never used high-frequency trading algorithms, and yet he is doing better than all of these investors, at least for now. So,
it's a really intriguing industry.
It is,
It's fascinating.
So I guess maybe to up the level of intrigue, we'll tell you just how successful some of these companies can be.
Sure.
So the most famous one is a company called Renaissance Technologies.
Yeah.
They were founded by a physicist, James Simons.
There you go. Didn't study finance.
Yeah. No, he's now worth 18 billion. Yeah. But to give you an idea of just how good these trading algorithms are, the company has basically it's an employees only fund. So only people who work for the company can put money in this fund. This fund, from 1994 to 2014, has averaged 71.8% return per year. That means every year you're getting 70% back. So
amazing returns. They'd all be multi-millionaires if all
billionaires. It's crazy.
How do you get involved in that?
So to give you some perspective, Warren Buffett, if you annualized out his return, it's about in the low 20s, I think. Yeah. And these guys,
which is considered incredible.
Yeah, phenomenal.
Yeah.
I mean, it's made him as wealthy as he is now.
Yeah.
But these guys for 20 years have averaged 70%.
70%.
It's
Yeah,
just-
like
it is
unheard of. Unheard of. And that's why I said in the start, in the Who Am I, you often hear that people say quant funds don't lose money. And that's because, I mean, you're not going to program an algorithm to put a trade through to lose money.
Yeah.
So, I mean, all right, if you get in on these, you'd be killing it.
The 1987 recession was partly caused by trading algorithms, because the way they were programmed was when the bottom fell out of the market, it triggered certain things in the algorithms that exacerbated the market collapse. But, you know, at this stage, these funds have figured out all their kinks, and they don't lose money because they've been through the 87 recession, the dot-com crash, the global financial crisis. They figured it out now. They know what they're doing.
I'd like to be able to give an example of like how these equations are built and what they're looking for, but like I wouldn't even know where to start. You know,
So it's things like when they see a difference in it's like the difference in the bid and the ask price on different markets, then they get that fraction of a difference.
So it's like putting two betting companies next to each other and sort of arbitrage.
Exactly. Yeah, that's a big one. Yeah. But, you know, to be honest, as I said, I don't really understand it.
So, did you want to add anything else there? I've got a sort of a question to wrap that one up.
No, far away.
The question I have is, what does this mean for the broader investing industry if computers can be programmed to do this and they're getting returns as such? Do we have a problem in terms of investors losing their jobs down the track, or
it's tough
when they bring in AI? Can these?
So I mean, because you would say that some investors would have lost their jobs because these trading algorithms and systems are doing so well, but then by the same token, all of a sudden, all these maths and physics PhDs have jobs to build the algorithms and build the supercomputers and all that. So, I mean, I don't know if it would be a net loss or gain. I think what we're going to see is that investors have to specialize in certain ways. So you're going to have less and less investors. You know, the old school stereotype on the floor or on the phone, like buy, sell, like looking at charts, like reading bits, yelling, all that. Yeah. Like that sort of generalist investor probably won't exist anymore. Yeah. What we'll have is incredibly smart, computer scientists and maths genius building these algorithms and building stuff like that. And then we'll probably also have more sort of fundamental focused analysts who, look at qualitative factors that computers aren't particularly adept at doing. So there'll be jobs. It'll just be different.
As an investor, though, if you have the option, as a mum and dad investor, and you have the option of putting your money into Fund A, which has an investing style where you've got analysts there looking at fundamentals, for example, or option of putting your money into a quant fund, like, wouldn't you just go straight for the quant fund?
Yeah, I guess. but the thing is, like, this is how bubbles form, you know? Yeah. Like, everyone is like, quant funds are going to make so much money, and so everyone starts putting all their money into these quant funds, and then the opportunities for these trading algorithms become less and less because there are so many more trading algorithms going for those. Yeah. So then they have to start taking more and more risk for less return. Yeah. Bubble forms, keeps growing. Yeah. All of these value investors and growth investors who are doing fundamental analysis, because they're being left out in the cold, there's all these opportunities because no one wants to play in their field. Yeah. And they start making more and more outsized returns compared to like the risk-reward skews. And then people recognize that there's money to be made over there, and then money flows in the other way. I mean, just all these things are cyclical.
Passive and whatever going on.
Yeah, exactly. Yeah, exactly.
All right. Well, we've done fundamental. We've done quantitative investing. Now for the third one. Who am I? My style evolves from the study of overall political and economic views and conditions of countries. I try to understand large-scale events to consider and then predict what impact it will have on companies and investing opportunities. Major considerations for me are things like interest rates, GDP growth rates, trade and foreign relations, and complex systems. One of the most recognizable examples of an investor using my style was George Soros, making billions of dollars from investing against the sterling. Investments are made across all asset classes using my style.
You are global macro
Yes, yes. Global macro. So that's our third style. And for those of you who are unaware, macro in finance and economics means the bigger picture. And so that's what this investing style is all about. And, you know, for me, there are some parallels with fundamental in some way, because you will use a macro approach in fundamental in terms of an industry scale or a trend scale. But macro doesn't necessarily look at the fundamentals of companies.
Yeah, I guess the distinction is, in a fundamental view, you're doing a bottom-up approach. So you're looking at the company, and then you're looking at how that company is positioned in a broader environment.
Yeah.
Whereas in macro style, it's top-down.
Yeah.
So you're looking at how whole economies are performing and how whole political systems are leading, and then you're identifying the opportunities there.
Yeah. That's a good way to put it. And that's pretty much it in a nutshell, really.
So probably the best way to explain this for people who don't quite get how you can trade based on like political outcomes and stuff is by way of some examples.
Yeah.
For example, right now, Venezuela is collapsing as a country. Nicolas Maduro has seized power after Chavez died. There's riots in the street. There's catastrophic food shortages. And obviously, like in a situation like that, you don't want to make money. Well, it's not the first thought, but macro traders out there, a lot of them will have made a lot of money by shorting the Venezuelan currency. Because as part of all this instability, the currency collapsed. So that's a way that you could capitalize on that political event. You know, another one, Brexit. If you shorted the pound when Brexit happened, you would have made a lot of money. I mean, if you look at something like what's happening in North Korea at the moment, because of all this global instability, you'll see people fleeing to sort of safe haven assets. So you look at going long gold, you look at going long the US dollar, things like that.
I would say one that I can think of is looking at things like the relationship that OPEC has going on. You know, the oil companies, how they decide how much oil they're going to be producing. That has flow-on effects on a global scale that you can then make decisions on what to invest
definitely.
in. All that sort of stuff.
Yeah, and I mean, so you can do macro analysis down to a company level. And what do I mean by that is, rather than looking at the company first and its balance sheet, you can look at what's happening globally and then make decisions about investing in certain industries. So you could say, you know, military tensions are on the rise. Trump is demanding that NATO all pay 2% of their budgets to military spending. China is building up its military at a really fast rate, as is Russia. I'm going to go long military contractors because of that, like, global macro trend.
Can you explain what long means?
Yeah, so that means you're going to invest in the companies. You're going to think that they're going to go up in price, rather than shorting, which is when they go down, which is when you bet on them going down in price.
To give another example of that sort of train of thought, relates back to what we were speaking about Alibaba before. If you start at the top and think, okay, so China is going through great structural change at the moment. We're seeing a huge increase in the number of middle income earners. That's going to generate a lot more revenue or expenditure from this population. Where are they going to start spending their money? Then you look at places like Australia, what they're going to be spending their money on, and then you look at companies that you think are going to benefit from this huge increase in consumer spending from the Chinese. So
definitely.
That's another macro approach.
Okay. Cool.
So
we got to give Daniel Want a plug here, because he is the very definition of a macro trader.
Big time.
And his interview, he's a seriously smart guy. So if you haven't listened to that interview, definitely check it out. He gives a good idea of what macro trading is.
I also want to mention that macro applies to all asset classes. And what I mean by asset classes is it's not just about stocks and companies. As you mentioned, Ren, you can look at gold, currency, oil, bonds, anything that you can literally put money in and get a return. Macro affects that.
Even
Iron
things
ore.
like commodities, wheat, corn,
nuts.
Literally, another macro thing. There's a drought in California. The global nut price will rise because California is the largest nut producer in the world. Let's go long cashew nuts. You know, like.
Floods happening in Southeast Asia, the rice paddies aren't producing as much as they were. Price of rice is going to go through.
Exactly. So when we've said in previous episodes, you can apply anything that's going on in the world. You can apply that to investing.
This is the way to do it.
This is sort of where you see that come through. Yeah.
Reading the news, that's where you start your macro approach.
Yeah, definitely.
So Daniel Want, check out his interview. As you said, Ren, very interesting guy, incredibly smart. And famous investors in this style, as I mentioned, George Soros, he made $1 billion from betting on price movements in the sterling.
Which is the British pound.
So I'm not going to say much more about that, but just go into Wikipedia and check it out. Super interesting story, and he had a very macro approach. So we've done macro, we've done quantitative, and we have done fundamental. That leaves us with 2 to go. So far, Ren, you're on 3 out of 3.
Oh, mate, killing it.
I thought we will go to... Well, who am I?
Don't tell me,
Charts and statistics are my best friend. The psychology of the market is often considered when investing in my style. One of my basic assumptions is that price changes are not random, so I can profit from trends as I look for patterns in price movements, volumes and averages to try and predict what's going to happen. I believe that past price behaviours are likely to influence future price movements more so than the intrinsic value of the company. Who am I?
You are technical analysis.
Bing, bing. Correct. 4 out of 4. So unless you really kook it, you're going to get the 5th one.
Tough to ruin it from here.
But yes, technical analysis. Now, that may sound, some of the things I said there, charts and statistics, that sort of stuff, people might get confused with quantitative in the sense that, maths and all that jazz, but they're 2 entirely different investing styles. So
this is probably the one that people associate with investing the most, looking at charts and trying to predict where the price will go. And there's a whole body of literature around technical analysis, and what they essentially do is they use charts and they use volume, so that's trading volume, how many buyers and how many sellers, to try and guess price movements. And there are all these things they use. In the charts, they identify different formations that they think that lead to different things. It's not something that I'm particularly...
I don't believe in it at the end of the day.
I didn't want to say it, but...
To be honest, you could have one technical analyst, and I mean this does apply to all sorts of investing, but you could have one technical analyst sitting next to another technical analyst, and their charts and formations could be completely different. And so it's just so hard to, formulate. If you're not really involved in it, looking at a chart and they're literally just trying to predict how a price is going to move. Just like quantitative and unlike fundamental, they're not investing in companies. They're not investing in the fundamentals. Not necessarily going long either. They're investing in price movements.
As a technical trader, you're just as adept at trading like wheat futures as you are at trading, government bonds, or gold. It's all about the technical indicators. It's all about trading volumes, trading patterns, and stuff like that. Now, look, just because we don't understand it, there are a lot of people out there who make a lot of money, including some of our friends who believe in it and do okay with it. But look, there is also a large number of investors that don't think it's very relevant. My personal opinion is, I think that there are some things that are true. Like using volume is obviously a good indicator of where price is going to move. You look at charts sometimes to see support levels. So if a stock falls, where it will sort of fall back. But I think then people extrapolate things that are true to an extent where they start getting into a bit of sort of murkier waters. And then there's a big situation of confirmation bias.
Yes.
So, when you really think about it, stocks are either going to go up or they're going to go down.
Yeah.
And
they use it to fit their own agenda.
Well, yeah. But, you could... No trader is going to get it right every time.
No.
But if you draw enough charts and then the price goes the way that you say it will, it doesn't necessarily mean that your theory of drawing on the chart is correct.
Yeah.
But look, we're probably going to get a lot of pissed off people listening to this at the moment because
it's just not something we agree with, really.
Yeah.
And
I just don't. I don't think historical performance necessarily means things will happen in the future. Trends are real.
Yeah.
But trends are real because of the underlying business.
Yeah.
Doing something that is causing that trend.
Not because of the chart.
The trend isn't the trend isn't causative. The trend is the effect.
Yeah. I mean, there are some charts that I will look at to somehow help substantiate my own thesis. And as I said, I just don't know enough about it, but I also don't really want to go down that path.
Yeah.
It's just not my style.
Yeah.
But as we said, by all means, give it a crack if you want.
So there are some people that have made more than a fluky amount of money doing it. So there's obviously something to it.
Yeah, definitely.
And we've got 2 examples to just give you an idea of the amount of money you can make.
Yeah.
So the first one is Marty Schwartz. Now, he started with 400 grand in his account. He made it into $20 million just using technical analysis. And then another bloke, Ed Sequoia, he was trading on behalf of one of his clients, and that client saw an increase of 250,000%.
Yeah.
That means
so
for
if
every...
you put $1 in, you get 250,000 back.
Which is just unbelievable. Literally unbelievable.
Yes, yeah. I want to point out as well that another characteristic of technical trading is that it's very short term.
Yeah, very short.
Very short term trading, just as quantitative is. These companies also trade short a lot of the time, meaning that they will not only be looking at price movements to increase in stocks, but they'll be looking at price movements that are going to decrease and looking to capitalize on that by shorting.
Now, look, I thought it was so unbelievable that I just double-checked that he actually did get 250,000.
And
it's true. He turned $5,000 into $15 million over 12 years.
Whoa.
So he got 250,000% return in 12 years.
Whoa.
That's actually so crazy.
I wonder if part of that was just one massive payday.
Oh,
you know
big
what I mean?
payday, yeah.
Or if it was a consistent return over 12 years.
So what? I'm 24 now, 12 years. Imagine if I had $5,000 put it in the market, and when I was 36, I walked away with $15 million.
You're retired.
God. Ed, if you're listening, give me a call. You can invest my money.
So just a quick summary on technical. It's short term, and it definitely uses charts and focuses on price movement and volumes, especially as their main as their main tools for trying to predict price movements. They look at the historical price movements and try and make predictions on what's going to happen in the short term. So that is technical analysis as a form of investing. So to finish, we've got the final one, the final Who Am I? Can Ren bring it home with 5 out of 5? The short one, I require little work or research, and I'm a relatively safe option for beginners. I track indexes and use weighted portfolios. Who am I?
You are passive investing.
Correct. Ding, ding, ding.
There you go.
It takes 5 out of 5. So passive investing, this is certainly one that is trending now in a big way. Not for no real particular reason. I think maybe because, we're starting to see technologies that are allowing it to happen. And
I mean, the reason is that actively managed portfolios where people choose the stocks or computers choose stocks aren't doing as well as just the overall market. And there's obviously lower fees
Management
involved
fees, yeah.
in the overall market. So people are seeing better returns if they put their money in a fund that just follows the whole market rather than giving it to a fund that's going to try and beat the market.
Yeah.
Yeah.
So passive investing comes from the idea that, Buffett sort of talks about that you can't beat the market.
Yeah, so there's a hypothesis. It's called the efficient market hypothesis.
Yeah.
And essentially what that means is that the market has already priced in all publicly available information, and it is efficient at getting the right price for any security or asset or share.
Yeah.
And therefore you can't beat the
that.
market
Yeah.
because the market is so efficient.
Yeah.
Now,
Which, in reality,
if that was true, then we wouldn't have investors getting outsized returns.
Yeah.
You wouldn't have market failure.
you wouldn't have people losing money.
Yeah. It doesn't make intuitive sense that the market is perfectly efficient. But anyway, that is the theory.
Yeah.
And the people who believe it, they just say put your money in an index and just let it follow the market, and you will do better over time.
And that's because time is probably one of the biggest considerations in passive investing, because they believe that over time the market is always going to go up.
Yeah, it increases on average over the very long term at about 6 or 7% a year.
Yeah, on average over a very long period of time.
Yeah. So that's when you smooth out, recessions and
GFCs,
bubbles and all that. Yeah, about 6 or 7% a year. So, if you're 20 and you put your money away in an index for 30 years, you're going to have a nice little nest egg there for your retirement if you just let it sit in an index. Yeah.
Something else that you mentioned before, and another consideration, and I guess a reason why people like passive investing is because of the low cost.
Yeah.
So if you're investing privately in any of the above that we've spoken about, you're likely to pay high management fees.
Yeah.
You're likely to pay fees for brokerage and all that sort of stuff, whereas a passive style is meant to be a low-cost option.
Yeah.
Put it in there, let it run.
To give you some idea, the sort of industry standard for actively managed funds is 2 and 20, which is 2% of all assets under management the manager takes as fees, and then 20% of any outsized profit above a certain threshold. So that's heaps. That's a fifth of your outsized profit if you're in a good actively managed fund. Whereas some of these indexes take less than 1%, like 0.1% in fees, because they don't do anything. They just literally leave it in the index, just over a long term. Yeah.
And over the long term, that makes a considerable difference. Yeah.
Cool.
So, what are some ways that you can be involved in passively investing?
So you would be investing in index funds, which are they're exchange-traded funds that just buy a basket of stocks that represent a market. Yeah. So the example that we use here is the ASX 200, which is the 200 biggest stocks in Australia. You can buy a ETF which has all 200 companies in it, and as the market rises 1%, that ETF will rise 1% as well. Yeah.
Passive investing is considered a lower risk option, and it also requires little time. You don't have to sit back and research individual stocks. You don't have to worry about price movements of gold or oil or whatever, because as you said, it's a weighted portfolio. You've got all the companies in there. You can just put your money in and let it run. So it's a very good option, and we've spoken about it a lot of times in previous episodes. It's a great option for beginners to have a look at.
Yeah, and to give you an idea of how passive investing goes against active investing, Warren Buffett in 2008 made a bet with Protégé Partners, which is an actively managed fund. Mm-hmm. They were allowed to pick 5 funds, and Warren just picked the S&P 500, which is the 500 biggest public companies in America, and they made a bet over who would make more money. By the end of 2016, the S&P 500 had risen by 85.5%, whereas Protégé had only seen 22% increase. So Warren literally just bought the American market and held it at that stage for 8 years, and he saw 85% return.
Wow.
Whereas these protege partners tried to pick the best of the best, and they only saw a 22% return in 8 years. Yeah.
There you go. So that's a great example of the passive style in action.
Yeah.
I mean, we have been in a big bull market.
Yeah. He got it in 2008, so like GFC, and then he's had some good.
Fortunate.
Yeah.
He did nothing, and came out on top.
Yeah.
So that's passive Ren. So we'll wrap up there. We've gone through the fundamental, we've gone through technical, we've gone through quantitative, we've gone through macro, and we've gone through passive. 5 styles of investing. And as you said right at the start, there's probably a number more, but that's the 5 main that we consider.
Yep.
I want to just quickly wrap up by asking you, what's your favourite style, and and I guess that leads into what does your portfolio reflect?
Yeah. So, as you said at the start, it doesn't have to be one or the other. So intuitively, I think that fundamental analysis makes the most sense to me because it's just conceptually I understand it, and it makes sense how that company will grow over time and the share price will reflect that. So fundamental analysis is definitely the analysis that I lean towards, and more I'm also getting interested in sort of macro because I'm interested in politics and all that stuff, and drawing that connection between that sort of interest and in my interest in investing has become something that has interested me.
Yeah.
What about you?
Yeah, I'm the same. I will often start with a macro approach to try and identify opportunities, and then, as I said, top to bottom, work my way, and then fundamental makes the most sense to me. I think, for me, investing is buying a business, and that's done through fundamental analysis, and I don't have and I'm playing to my strengths as well. Like, I don't have the skills to get involved in quantitative investing, and I just don't really see. I mean, I'm a strong believer in passive as well. Don't get me wrong. I am involved in that. My portfolio reflects that. But I just, as we've both mentioned in a number of episodes, I love the way that macro and fundamental investing force you to look at the world in an intriguing way.
Yeah,
it keeps you very open-minded, and you don't have to be a whiz to do it.
No, well, we're definitely not, and we're managing through it. So, cool.
Yeah, well, that's a wrap. We've gone through the 5. We have given you a few things that we've learnt during the week, but more importantly, we're doing this live together for the first time in a long time. And it's good to be down in Melbourne, and it's been a fun episode.
Yeah, and we're looking forward to bringing you a cracking interview next week.
Yes, well, that's the reason I'm down in Melbourne, because Monday...
we won't say any more. We'll leave you in suspense.
Yeah, we're very excited to bring you this next guest.
Yeah.
We'll leave it at that.
Yeah.
But definitely tune in next week. And we really look forward to bringing this guy to you.
Yeah.
So...
Equity out!
Equity mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.